Hello and welcome to the latest investment briefing of 2023 from us here at Gemini Asset Management. We faced some significant market events and economic developments that have left investors with both a mix of optimism and caution. In this briefing, we'll touch on market performance and the impact of the SVB banking collapse, economic outlook for various regions, and the quandaries of holding cash. Figure 1 on screen now shows the performance of major equity markets over the quarter. Last month proved to be a volatile time for global equity markets, primarily due to the fallout from the Silicon Valley bank collapse and expectations for central bank policies. These factors led to notable sell-offs in March, giving up the gains made earlier on in the year. Equities did bounce back though in the latter stage of the quarter, as ideas of containment rather than contagion encompassed the potential banking crisis. The failure of SVB was certainly an interesting case though, as it became the largest bank to fail since the 2008 financial crisis. The collapse of SVB was driven by interest rate mismanagement within the bank, as they'd been investing a large percentage of their deposits into long-term bonds, rather than holding more of it back as cash. These long-term bonds lost value, as had been typical for bond investments in the last 18 months, and then they couldn't raise the necessary cash to meet the demands of the customers requesting their money back, which is a recipe for disaster for a bank. The downward pressure on equity markets was then further fueled by the concerns surrounding Credit Suisse's struggles, and especially short selling in the financial sector. Short sellers are essentially investors that try to make money as the price of an asset goes down. Credit Suisse then subsequently received a bailout and was purchased by UBS. Their troubles, however, started years ago and were rooted in risk management failures and insufficiently aggressive turnaround plans. Let's now turn our attention to the outlook for different regions. In the first quarter, there was essentially positive economic news, and this came as quite a surprise. Figure 2 on screen now shows the economic surprise indices for both G10 and emerging market countries. If the index is higher than 0, it means the economic data points being reported are stronger than they were expected to be. Both G10 countries and emerging markets show positive results. From resilient labour market data to improvements in the Purchasing Manager Index business surveys across major developed economies, the news was essentially positive. And over in China, post-pandemic reopening is a strong driving force for economic rebounds. However, this isn't always good news. Earlier in the quarter, improvements in the global economy led to markets expecting higher interest rates for a longer period of time, as central banks would essentially have to continue their hawkish monetary policy stance, and then hopefully that will bring down inflation. The better the news, the higher the market's expected interest rates to go. As we know from 2022, this caused struggles for bonds and weighed on equity markets in February. It's a classic case of good news becoming bad news, because good news for the economy is then bad news for the asset prices, as investors bet on the central bank policy changes. Now let's look at holding cash in today's market conditions. Long-term cash deposits struggle to keep up with inflation, eroding real returns. Remember, it's time in the market, not timing the market that matters. Attempting to time the market by moving in and out of cash can lead to misplaced opportunities and suboptimal returns. Figure 3 shows the returns achieved by the MSCI World, which is a global equity index. The grey line shows the return of the MSCI World over a 20-year time period, and the red line shows the return to the MSCI World over the same 20-year time period, but excluding the 10 best days in the market. As you can see, there's a big difference. If you try to time the market rather than following the time in the market principle, it can have a substantial impact on your cumulative returns. Locking cash away for fixed terms, with inflation as high as it is, currently 10.4% in the UK, will guarantee a loss in real terms, as the interest paid is far below the level of inflation. But staying invested, there's at least a chance that you could still make positive returns. As we've seen, even with unexpected events like the SVB collapse, recessions, no recessions, or global pandemics, remaining invested through various market cycles can provide investors with better results than when they're trying to time the market and hold cash at different times. Essentially, holding cash has underperformed radically in the long run. That's all from us here today at Gemini Asset Management. Thank you for watching, and we'll see you again soon.